Hey, good morning. This is Chris, Suarez Home and Finance, Coffee with Chris, Monday morning. So I'm in Florida and we're expecting some crazy weather this week. So I hope you have all of your toilet paper and your water and all that kind of good stuff. One of my assistants, Joyce, is in the Philippines, and oh my gosh, they just got hit with a typhoon, and so we're thinking about all of those people. Thankfully, Joyce and her family is okay. And so we just hope that in Florida, the hurricane is coming. Hopefully it'll die down. Who knows what's going to happen? I'm in Central Florida. Thank God we have not been hit directly to me. We did with Irma, I think in 17, just lightly. But I also moved from Tampa, which we never got hit with Tampa. So anyways, hope that all of you stay safe this week. Hope that you're ready for it. Better to be prepared than not, I guess, right? Those those of us that are from the Tampa area, we kind of blow it off and don't get prepared. So I think the last couple of them that have come close, I think we've kind of looked at it a little bit differently anyway. So I know we have in my house, my husband and I have. So anyways, wanted to just say our thoughts are out to those in the Philippines that have been hit, and hopefully those that are in Florida, hopefully we all stay safe. So let's get into what we're talking about this morning. So this morning we're talking about line of credits, which is called a HELOC, second mortgages, and bridge loans. So line of credit, it's whenever you hear the term HELOC is home equity line of credit. We're getting into here, and so a home equity is a line of credit on your existing home. So whether it is a primary residence or a second home, it's not normally oh, Sarah said I've got bad audio. Okay, so let me see. I'm on here. Let me see if I can fix my audio while we're going. Hey, Sarah. Let's see. I will change it to this one. So hopefully this is better. So I've got my microphone in front of me. So Sarah, let me know if we're okay. Joyce, am I good? Okay, so hopefully I'm good now. So a line of credit. So what that means is that it is interest. Oh, good. Okay, thanks, Sarah. Appreciate you. Love you. So a line of credit is you're taking the equity that's on your home and you're using that in order to do all kinds of things. So in this world that we're in now, okay, um, if you are buying a new home, you can use the equity to buy a new home, which we're going to talk about that a little bit more in a minute. But with interest rates going crazy as far as now is concerned, a lot of times if your interest rate on your first mortgage is low, you really don't want to touch your first mortgage. And so, but you do have enough equity in there to where that it would really be behooving to use that equity to pay off some debt. So for instance, I've got a client that I'm working on right now that $700 a month or so, give or take, in monthly debt. If we do a line of credit, that possibly can reduce that payment by half. So it can be a very good thing. I'm looking at doing it myself just to do some things that we're looking at doing. And so, there is the benefit of doing that. So here's the thing with a line of credit. So it is normally, and I'm telling you, whoever you're using for your financing, you have to go through them, you talk to them or whatever. If you're working with somebody else besides us, for instance, get the criteria because everybody is a little bit different. So it's an interest only payment for the first 10 years in a normal scenario. So what that means is that, let's say, for instance, you do a loan for 100,000 and your line of credit rate, which is going to be different than a 30-year fixed rate mortgage, your line of credit rate is 8%. I'll explain that in just a second. So if it's 8%, you take 100,000 times 8%, which is 8,000, divided by 12 months. That is your monthly payment. It's again based on interest only. You can make extra principal payments all you want to, absolutely. And but at the 10-year mark, your total principal is now your payment is going to now adjust to a principal and interest payment, fully amortized over the next 20 years. That's if you've not made any payments towards the principal during the process of that first 10 years. So what happens? How is the interest rates on a line of credit arrived? So the interest rates are, it's based on the published prime rate, which as of last week was 5.5. It did go up last week on the 21st, I think it was, to 6.25. So it did go up by 3/4. When you hear the Feds announcing, which we've talked about before, the Fed's announcing an interest rate hike and so on and so forth. On a 30-year mortgage and on a regular mortgage or whatever, it's not always 0.75% right away. It's sometimes as far as how much that costs, different things like that or whatever. And a lot of the banks already put those things into place. So you don't see, there's only one time I think in all of my history that I've seen that whenever something happened like that, that it actually did increase the rate by 3/4. So it just depends, but they are changing. They're constantly changing. Um, we are locking, you want to be locked up front if possible. My suggestion, not, depends again who you're working with and so on and so forth. I used to not do that because I used to watch to see because I've saved clients tens and tens of thousands by watching the market. I don't do that right now. Again, talk to your financial person, so on and so forth. So the interest rates are based on the prime rate plus what I call hits or points that are added to that. So that is based on what is your credit scores? What is the dollar amount that you're going to be borrowing? What is your value versus your first mortgage and your new line of credit mortgage? What is that total percentage? So if your house is valued at 300,000, your current mortgage is 100,000, you want to take another 50,000. So then that means that your total liens would be 150, your value is 300, so you would be at 50%. That's how that is looked at. So a lot of things still affect the line of credit rate the same as a lot of things affect a 30-year mortgage, 20-year mortgage, all of the other things. So um, that is, so with a line of credit, I used a line of credit whenever I sold my house in Tampa and I bought my land in Hernando. So what we did is that we did a line of credit on our home. A line of credit on your credit looks like a credit card, so to speak. It's revolving. Revolving really affects your credit scores a lot. And so if you're maxed out on a revolving credit card, then it can decrease your score anywhere. I've seen it 50 something points, so on and so forth. When we did our line of credit, I was going to do our construction loan to build, but because we took the total amount that we got for our line of credit to put on our land, my husband's credit score dropped by 100 points. So it's also something, to look at depending on why you're doing a line of credit. We have another option now to do something like that, so we'll talk about that again in just a few minutes. So that's kind of how a line of credit works. So the thing that you have to decide and think about if you get a line of credit, is it to pay some things down? What is your long-term goal? Are you going to be paying off debt to decrease your monthly payments during the time of inflation, everything else or whatever? Think about it. Does it make sense? So on and so forth. We're working on a lot of people right now with lines of credit, and it makes sense to do it. Are you going to, should you do a line of credit to pay things down because you're going to be selling within 5 or 10 years? Remember that your payment goes to principal to principal and interest after 10 years. So does it make sense? So we talked about how the payment is calculated, so on and so forth. Some people take a line of credit to buy another, like an investment home, for a down payment or to buy an investment home cash, whatever the case is. So that's kind of how the line of credit works. When you are doing these, again, your credit score is a major part of this. If your credit score is a 680 versus a 780, the difference in your interest rate as of right now, I looked this morning, would be approximately 3.86% because your credit score is a 680 instead of a 780. Your credit scores are so important right now that you need to be at the highest that you can. Now, with the option that I have, and again, whoever you're doing financing with one of my options that I have for a line of credit, you can actually we can do an Experian Boost, which you see that on TV and everything else. And I'm actually trying it out on my own to see really how much my score would increase. So, in other words, with the Experian Boost, if I understand all of it correctly and so on and so forth, is that I link it to my bank account. I pay these bills, my electric bill, whatever it is, every single month, blah, blah, blah. It's instantaneously, or it happens right then and there as far as what your credit score would go to. So that could increase my credit score from a 680 to a 780. So I'm kind of playing around with that because I like to give you real world experience that I've seen and, done and messed with and everything else. So I'll let you know how that goes. So that is something that is a benefit as far as, doing the line of credit. Again, credit scores are huge. So let's go into a second mortgage. So a second mortgage is you have your first lien. That is your first mortgage. Some people don't have a first mortgage, and so this wouldn't be a second mortgage. It would actually be a first. But for this purposes, second mortgage is second lien position. So a second mortgage is going to be a fixed rate mortgage, unlike a line of credit. You can do terms anywhere from 5, 10, 15, 20, 25, 30 years. Again, based on debt ratio, credit score, how much you're borrowing, how much your house is worth, all of those things come into place. A second mortgage you can do on a primary residence and a second home. Investments are iffy, so it depends on your finance person. But a primary and a second home, yes. Um, all of these things all of what I'm giving you is pretty normal in the grand sense of, in the grand scheme of things with most finance companies. So again, you're going to have to check and see who you're talking to. Would love to help you. Give me a call, blah, 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 all that good stuff. But I'm here to educate you, give you information. So, when you are doing, um, when you're buying a home, you can actually do a line of credit or a second mortgage at the same time as buying a home. So what that means, again, using the $100,000 base dollar amount just for easy numbers, if you're buying $100,000, you can have a first mortgage for 80,000 and get a line of credit or a second mortgage, say for 10,000. So you're only putting 10% down, $10,000. This eliminates mortgage insurance. So again, does it make sense? And so if your credit scores are lower, then it could make sense. If your credit scores are higher, sometimes the mortgage insurance is very little and it makes more sense to do that. I've had clients that their financial advisor, which I think we've talked about before, um, have said that it makes more sense to do mortgage insurance rather than taking your money from your retirement and your 401k. So again, financial advisor person conversation, check it out. I'm telling you what I know and what I've seen and what I've been told. So in doing this, you're going to end up with if you use a line of credit or a second mortgage to buy a home, you're putting less money down, so on and so forth. So you do have the first and second mortgage on your house. So it can be a benefit. We've also done that in the sense of that you have um, unwarranted condos. And so we've done that in those cases too. And so it's been a big benefit there. And we've actually gotten them closed because we were able to do a first and second like that. So that's another option to use a second mortgage or line of credit for. So there are minimum loan amounts as well as we can, you have to, it depends on what, the numbers are. Your finance company may have a minimum dollar amount that they can go. So um, again, conversation. It depends on I'm kind of skipping around here. Sorry. So anyways, so keep in mind that you all have a max debt ratio also with this. So you have a max debt ratio as far as just like a first mortgage. So your debt ratio means your first mortgage, the new mortgage, which is the line of credit or second mortgage, plus your debt that's on your credit report, and any, like, if you owe IRS money, which a lot of people owe. That's a coffee with Chris a couple of weeks ago, with an accountant. So your debt ratio is that, and then your gross income. So even though that you have a line of credit, even though you have all this equity, so on and so forth, your debt ratio still matters. So that's still a calculation, just like your credit matters, your debt ratio matters. Some people on these loans ask if there's a prepayment penalty. In most cases, the answer is no. In my case, the answer is no. Again, your finance person, do they have a prepayment penalty or not? So just confirm that. I don't think I've done a loan with a prepayment penalty in years. If I did, it was because we did a hard money. But in a normal sense of the word, no. So now we're going to go to a bridge loan. So what is a bridge loan? A bridge is kind of the what it says. It's a bridge. So whenever you're buying, if you are planning on selling your home, and I've got a particular client right now that we're going to be giving a call and saying, okay, wait a minute, just thought about this option or whatever, instead of waiting, is they put their house, they've been looking for a house for a while, and they couldn't find something that they thought that they liked. They didn't want to put their existing home on the market until they had a new home, which is most of the time that's the case. So they finally found their home, they put a contract in, so on and so forth, and then, oh my god, the market changed in the last month, and so they didn't get an offer as quick as what they thought, and so the closing on the new home was not going to work. The timing was not there. So in that instance, a bridge loan may be the answer for you, that you're getting your equity out of your home that you own now, and then in order to buy a new home. So in doing that, the terms on that is normally like a 12-month term, because you're using that money to buy a home that your current home is being listed for sale. So it's a quick bridge. Um, so that's what a bridge loan is. And so again, it's about a 12-month term. Your credit still counts, your debt ratio still counts. um, right now we're looking at probably, and again, depends on your financial, people or whatever, about 75,000 up to $5 million. So if you own a big fat huge home and you need lots and lots of money, it's a possibility. So it just depends on what your criteria is and what you qualify for. So um, if you, let's say for instance, if your value, in a lot of cases you can borrow up to 80% of the appraised value. Again, if your home is worth 100, you can borrow up to 75% with your current mortgage plus your new, so that's 75,000. Again, just using those for round numbers, you can do the math on that. So about 75%, or about 80% rather, I'm sorry, 80. And then if it's over a million, then normally about 75%. Again, based on your financial company's criteria, and what their guidelines are. And I missed a screen here. So that is a bridge loan. So in the grand scheme of things, where we went through this kind of quickly or whatever, but so a line of credit, just as a recap, a line of credit could do you well as far as saving you monthly payments. And again, in the world that we're in right now, does it make sense for you to do? Does it make sense for you to um, pay off a car with that? Your car, if you're at a higher interest rate, your terms are shorter, whereas a line of credit or second mortgage, your terms are longer, but it gives you breathing room. And I always use the example of, if you save $500 a month, take half of that and put towards your line of credit. So you have your monthly payment. But again, if you're saving 500, take half of that and start paying down the principal. You're saving the 500 a month. Why not? Also on a line of credit and on a second mortgage, you'll have to check with your accountant, your finance person, IRS, whoever. But I believe some of that interest is able to be written off, whereas a car, the interest is not able to be written off. A credit card, your interest is not able to be written off. Again, if it's on a home, it's possible. I was on the phone with somebody the other day. I think it was actually Jennifer that works for me. and we were looking it up or whatever, and she Googled it real quick, and I think that she was reading, you can write off the interest on a line of credit if it's used for renovations and different things. So just again, talk to your financial person. My allergies are going crazy. Talk to your financial person and see what they say. And again, does it make sense for you? For me right now, I think some of it makes sense, as far as what I'm looking to do. So it's a case by case. Um, and it just, it saves you the money. It is a possibility. The line of credits kind of went away after 2008. Um, they've been slowly coming back, and now they're, kind of back in full force. I think banks could still do them, but a lot of people like myself could not do them. So the bridge loan again, so you've got the line of credit, you've got the bridge loan, and you've got the second mortgage. So you have options to use for the equity that you've got in your house if your interest rate is low enough to where it does not make sense to touch it. And again, in a lot of cases, it does not make sense. I've got clients that we closed, however many years ago, 2, 3 years ago, whatever, and some less than that, that are in the twos and threes. Oh my gosh, don't touch it. So if you've got the equity, again, does it make sense financially? So hopefully this helped you to make some more decisions. Hopefully this gave you some more insight as far as what these things are and what they mean. I'm all about, educating you, letting you know, giving you information, all of that kind of stuff. Please make sure and share this with anybody that you know that owns a home or looking to buy a home or whatever. This is great stuff, and it's a avenue that is not really thought of a lot. But it's definitely a big plus if you've got equity in your home. So, and we know the values have increased. We've got a couple of tools that we can see, as far as, what your equity could be. A lot of times an appraisal is required. And so again, it just depends on who your finance person is, what's going on, what kind of loan, all of the above. And so conversation, just as always, I repeat it all the time, have conversation. So um, this about concludes everything that is today. And so again, hope that everybody in Florida stays safe and prepares for our lovely weather coming. And please share us everywhere. Please do all of that kind of stuff. We're on Facebook, Instagram, YouTube, all of the above. We've got a website that we're working on, coffeewithchris.live. All of the podcasts, we're working on putting them all there, so we're all in one place. So if you need anything, if you've got any questions, even if I'm not helping you, I would be glad to answer them. So whether you are a realtor, whether you are a homeowner, whatever the case is, we are here for you. So hope you have a good day. Hope you stay safe. And we will talk to you next week and Monday at 10 o'clock. Talk to you later.